Hello, everybody, and welcome. This is problem 17-17. We're talking here today about a fair value hedge, and so let's take a look at this. On October 15th, oil products purchased 4,000 barrels of fuel oil with a cost of $240,000. Oil products is holding this inventory in anticipation of the winter 2021 heating season. Oil products accounted for this inventory at the lower of FIFO cost or net realizable value. To hedge against potential declines in the value of the inventory, they also purchased a put option on the fuel oil. Oil products paid an option premium of $300 for the put option, which gives them oil products the option to sell 4,000 barrels of fuel oil at a strike price of $60 per gallon. The option expires on March 1st. The following data are available with respect to the values of the fuel inventory in the put option. Okay, so let's take a look at right over here. So we're going to have two things going on, is what we've kind of learned and throughout all of this. We're going to have over here, we're going to have a put option, time value, and we will also have a put option, fair value. So that's going to be how we're going to account for that option. But at the same time, we're also purchasing inventory. And so we'll keep that over here. So let's go ahead and take a look. So right over here, the journal entry. So I purchased the fuel oil and the put option on the fuel oil. So here for A1, I'm going to be debiting inventory. This is going to be for $240,000. I'm going to be crediting cash. And this is going to be on 10, 15, 20. Okay. At the same time, I'm also purchasing the put option. And again, this gives us the right to sell it at 60. So right here for the put option time value, I'm going to debit. And this is going to be for, I purchased this for $300. Okay. So my put option time value is going to be here at 300. My inventory here is at 240,000. Okay. So with that all being written out, let's now take a look at October 31st. Halloween. All right. So oil products prepares financial statements. So as always, let's go ahead to A2. So we're going to have a couple different components going here. First, our first component is, let's go ahead and deal with the time value of the put option. So this was as of 10/15. As of 10/31, this time value of the put option is 175. So in order to adjust for this, I need a credit for 125. And this is going to go down over here to an unrealized holding gain. And this is going to go over here for 125 on 10/31. Okay, so over here, 10/31/20. I'm going to credit put option time value for 125. I'm going to debit unrealized holding gain or loss on income for 125. Okay, that's the first one. The second thing we also need to do here now is that our fair value of our put option has actually gone up. So here we go. So my sell price is at 60. My market price of the oil, or my buy price, this is going to be on October 31st, is at 58. So the value of this put option as of right now over here is going to be at $2 per barrel. And so I've got $2 per barrel here. What did I call this before? God, I'm totally like spacing out. Let's see here. What did I call this? Gain. Okay, that sounds good. All right. So over here, I've got a gain of $2. Remember, I have the right to sell at 60. If I can buy it at 58, I'm going to make a profit of $2 per. So right over here, let's see. So it's 4,000 barrels. So over here, this is going to be a put option fair value is going to be $2 times 4,000 or 8,000. Okay, this is going to be on 10/31. And then over here, I'm going to have an unrealized holding gain or loss on this here at 10/31. Okay, so this is going to be put option fair value of 8,000. And then over here, I'm going to have an unrealized holding gain on the fair value. Or so only like holding unrealized holding gain or loss on income. Okay. So the other thing that we need to do too is, as we're looking at this here, I have an issue with my inventory because the value of my inventory is no longer going to be $240,000. That's right, because on October 31st, the value of these 4,000 barrels has gone down. I paid $60 per barrel for this. So what I'm going to have to go through and do is I'm going to have an unrealized, an allowance to reduce inventory to market. And we've seen this before. So I'm going to have an allowance here to reduce inventory to market so that when I show this inventory on my balance sheet at October 31st, it's not going to be overstated. So what is the amount that I need to be showing here? So if I spent $240,000 and this was barrels of 6,000, price per barrel, I paid 60. Actually, this is 4,000 barrels. My price per barrel is 60. So over here, my total inventory cost is going to be 4,000 times 60 or 240,000. Now, but the market value here market price barrel is going to be at 58, which is coming from right here. Okay. So my market price per barrel is 58. So the inventory market value is going to be 4,000 times 58 or 232,000. So the allowance to reduce inventory to market is going to be 8,000. Okay. And then over here, I'm going to have so I'm crediting allowance to reduce inventory to market. So this now has an ending balance here of 8. This again is a contra asset account. It's going to go over here on our balance sheet. And then I would be coming over here and debiting an unrealized holding gain or loss for this 8,000. So as we're kind of looking at this here now, that if the prices go down, if we buy the oil and the prices go down, this is really kind of making us whole. Because just by having this option, if I didn't have it, this price would be going, I would be losing $8,000 on this. But by having this hedge, I don't have that going on. Okay. So right over here, so 10/31/20, I'm going to have a debit to unrealized holding gain loss on the income of 8,000. And then I'm going to have the allowance to reduce my inventory to market for 8,000. Okay. So let's go over here. So this is at 10/31. So I now go to my next month here, Oil Products prepares financial statements. So when I'm going through over here, so my put option time value as of November 30th is now going to be 105. So I need an adjustment here of 70. And this is going to be as of 11/30. So on 11/30, I'm going to go ahead and debit unrealized holding gain or loss on income of 70. So right over here. And I think what I'm going to do to make this a little bit easier, so this will be as of 10/31/20. Excuse me, there's only 30 days in November. Okay, so this is going to be 70 on each of these. It's essentially the same journal entry over here. Next thing I need to go through and do is do my, what's the value of the put option? So over here, my sell price is still at 60. My buy price is now 57. So my gain is $3 per barrel. Barrels over here are 4,000. So the fair value of my put option is now going to be at $12,000. So over here, if my put option fair value is going to be 12,000 on 11/30. So I'm going to need an adjustment here for 4,000 and 4,000. So this is essentially, we're going to follow the same link or the same kind of formatting here. Okay. And then the second thing I also have to go through and do too is on November 30th. So I've got the put option fair value, but now I have an issue with my inventory. Okay, so on 11/30/20, I still have 4,000 barrels. My cost was still at 60. So my total inventory cost here is at 240,000. But now the market price has changed. It's now $57 per gallon. So my market price per barrel here is going to be at 57. So my inventory market value is going to be $228,000. So in this case here, my allowance that I needed here on the first one was 240 minus 232. My allowance here is going to be 240 minus 228. And why don't I just do a little quick summary here in terms of showing you how we're computing all of these items. So this will be A times B equals C. We'll call this D. A times D equals E. C minus E is my difference or the allowance. So over here so this was my ending balance at October 31st. My ending balance in my allowance account needs to be at 12,000 over here. So my adjustment or my allowance to what I'm going to need to do here, it's going to be 4,000. And over here, it's going to be 4,000 on 11/30. Okay. Let's see how we did on that one. Yes, perfect. Okay. Now, let's go ahead and do this as of December. So again, we have 3 components here. So the market, so let's go ahead and do the put option time value first. So as of December 31st, my time value of my put option is at 40. So my adjustment here is going to be 65. So going over here to our journal entries, 12/31/20. This will be 65 and 65. Okay. So the next thing I need to do here is what is now the fair value of my put option. So on 12/31, my sell price is still 60, my buy price is 54. So I have a gain here of 6. Barrels are at 4,000. That's how many, it's my option to sell 4,000 barrels. And so now my put option fair value is at 24,000. So over here at 12/31, the fair value of my put option is now $24,000. So the adjustment I'm going to need to get to that option or to that fair value is going to be 12,000. And that will be a gain over here for 12,000. Okay. The next one over here is this inventory is no longer worth, still it's dropping in value. My barrels have dropped in value. So over here, I still have my same cost. However, in terms of market value, the market price is now $54 per gallon. So I'm going to need to go through and I'm going to need to change my inventory, my allowance to reduce inventory to market. So here, this is going to be 4,000 times 54. So the allowance is going to be the difference between 240 and 216, or I'm multiplying instead of subtracting. So this here is going to be $24,000. So my adjustment that I need to have here is going to be 12,000. So over here, as I'm going through, as we saw over here, the put option fair value, this was 12,000. So this is going to be 12,000 and 12,000. And similarly over here, I'm going to have an allowance to reduce inventory to market of 12,000. I'm also going to have an unrealized holding gain or loss on the inventory because I have not yet gone through and sold that inventory yet. Right over here. This is going to be 12/31 right over here. So a lot of, as you kind of notice here, because this put option is really hedging my losses. So when I look at the amount I've actually lost or It's just going to be the amount of the decrease in the time value, about $240. This will be about $260. Okay. Let's go through now. So I prepared financial statements. So the journal entries, so right over here, I've gone through and I've done those parts. So indicate the amounts reported on the balance sheet and income statement related to the fuel oil inventory and the put option on November 30th, 2020. Okay, so on the balance sheet, under my assets, as of 11/30, I'm going to have inventory at 240,000, less my allowance to reduce inventory to market. And this is going to be on 11/30. This amount here was 12,000. So my inventory net of allowance is going to be 228,000. Now, in addition to this though, I do also have on 11/30, the put option has value. So put option time value as of 11/30 was 105. Fair value as of 11/30 was $12,000. So total value of the put option is going to be over here at 12,105. Okay. So we'll say this here is as of 11/30. Okay. In terms of the income statement. Okay. So what goes on my income statement? You could look at this as the unrealized holding loss on inventory. So this would be here. Let's see what it's asking us to do. So this is for the month ended. So it's just asking us for the month ended. So we'll say month ended 11/30. And so this is going to be an unrealized holding loss on inventory of, this is going to be 4,000. And this is really where this is kind of coming in from over here. So that's basically, that was like my loss. And then I have my unrealized holding gain net. And this here is going to be, it is going to be over here with my, what happened over here. So on 11/30, I had 4,000 minus the time value of 70. So over here, other income loss. So this is going to be a loss of 70. Okay. To go through and do this here as of 12/31. Okay. Inventory value is still 240. And over here, my allowance as of the end of the year is now at 24,000. So my inventory net of the allowance is 216,000. At the same time, I have my value of my put option is at 40 for the time value. The fair value is at 24,000. So my total value of my put option is going to be at 24,040. For my income statement, and this is going to be for the month ended 12/31. My unrealized holding loss relating to the inventory is going to be 12,000 because that's what I lost during the month. That was the decline in the value of my inventory. However, this was counterbalanced by my net gain, which is going to be plus 12,000. That's for the put option right over here for the fair value, but I will subtract out the 65 relating to the time value of the put option. So my other income or loss net is going to be $65. Okay. So that brings us to the end of problem 7-17. Thank you for joining me here tonight, and I look forward to seeing you on the next video. Have a great one.